Business editor Charles Pellegrin is joining me here on set now. He's going to look at how the markets are reacting, of course, to this escalating violence in the Middle East. Bring us that, first of all. What's the reaction, particularly, notably on the oil markets as well?
So directly after Iran fired its missiles towards Israel, oil prices surged up 5% for the Brent crude, for instance. This has now been tempered somewhat, with both the West Texas Intermediate and Brent crude benchmarks trading under 2% higher, as you can see there, at over $70 and $74 a barrel, respectively. The missile strike and a potential Israeli response that would target Iranian oil production facilities, as has been reported by U.S. news outlet Axios, is posing a threat to global oil supply, which is pushing prices up. For oil markets, this represents a change of tune. In recent months, geopolitical risks like those seen in the Middle East had been brushed aside, with focus being more on increased U.S. production, as well as an increase in OPEC output slated for December. And slow Chinese demand, the world's largest oil market, had also lowered pressure on prices. As you can see on the Brent crude, was trading at over $80 a barrel 3 months ago and has been steadily declining. Now, more traders are betting that trend could be reversing, potentially bringing the price of a barrel of oil to over $100.
So how exactly would an escalation of violence hurt the oil supply, Charles?
Well, there's a number of ways the oil supply could be affected. Clearview Energy Partners estimates that if the U.S. and its allies further tighten sanctions on Iran, that would add $7 to the price of a barrel of oil. If Israel targeted Iranian oil infrastructure with military strikes, that would hurt a country that represents up to 4% of global oil supply and produces between 3 and 4 million barrels per day, and would increase the price of a barrel of oil by $13. They estimate, though, that what would cost the most would be disruption of trade flows through the Hormuz Strait, between $13 and $28 a barrel. Tehran has the ability to control who enters and leaves the Persian Gulf, as it controls that narrow waterway through which 30% of the world's oil trade travels and 20% of the world's liquefied natural gas. This geographic feature means that countries like the United Arab Emirates and Qatar, also big oil producers in their own right, are in effect trapped. Iran could fire missiles at ships going through there or send patrol boats to intercept them. In addition, the waterway is shallow enough that ships could be vulnerable to sea mines.
So what's the impact on the wider markets, then?
Well, fears about the situation in the Middle East led to declines on Wall Street at the close on Tuesday. That hasn't fully translated onto Asian markets this Wednesday. The Hang Seng in Hong Kong opening again after a public holiday and still reacting to economic stimulus in Beijing. Property developers really fueling gains there, up almost 6%. Mainland Chinese bourses are closed for a holiday. The Nikkei in Tokyo and Kospi in South Korea have closed in negative territory, though. In Europe, meanwhile, at the open, markets are higher or flat. We'll have those figures up shortly. Investors there looking beyond Mideast tensions and focusing on employment data for the region. The oil and gas sector, unsurprisingly, leading the gains, up just short of 1.5%. As a reminder, though, oil represents over 30% of the world's energy mix and is still the fuel of choice. So an increase in oil prices would have a sizable impact on prices and inflation, which could in turn hurt consumer demand and economic activity, which is already in a fragile state currently in Europe.
Charles, thanks so much, Charles Pellegrin, our business editor, summing up the economic problems related, of course, to those what's been happening in the Middle East over the last 24 hours.